Welcome to Trading with Rich. My channel is about financial planning your future, investing suggestions, and any other financial topics that my subscribers want to talk about. Hello, Trading with Rich. Rich here again. As promised, this is day 2 of the Alibaba covered call. So BABA stands for Alibaba. So see my hand here? We are doing an Alibaba covered call for 10 contracts. So in review, when we did the video yesterday, there were 10 contracts, which is 10 times 100 shares equals 1,000 shares. So we're doing Alibaba for 1,000 shares. We put a target price of $90 out there, and we set it for December 2nd, 2 weeks ago. So how much did we earn on 2 weeks of the covered call? Well, we were paid a premium of $1,304. So the other trader on the other end said that they would pay us $1,304 if we would be obligated to sell the stock for $90 to them all the way up to and including December 2nd. Now, 2 weeks ago, they paid us $1,304. Now, from that day forward, I could have gotten out of the obligation by paying a certain amount of money. And as you noticed yesterday, the money was $1,100. I would have had to pay $1,100 to get out of the $1,300 from the original agreement. Today, look at this. The price went down about $2. It's now $85.94 instead of $87.97. It went down about $2 from yesterday. So what did that do to the buyout clause? Right here, my mark. Well, I'm the mark, and I would have to pay $325 to get out of it when the market opens up at 8:30 in the morning. So the market's closed after Thursday at 3 o'clock. That was December 1st. Video from yesterday. Yesterday said I could get out of it for a little over $1,000. I believe it was $1,025. And now that obligation amount has dropped $800 bucks. So it might still be a great idea to get out of this first thing when the market opens. But I'll check the pre-markets and see what Alibaba is scheduled to do. If it's scheduled to jump $8 and it's currently at 85, that would be 93. I'll try to get out of it, but I don't believe that's going to be the case. We've already had 2 large jumps this week, about $6 and $7. So if this thing goes up $5, no problem. I'll go ahead and buy it back and keep all my stock. If it goes up to 93, I'll just let the stock go for 90. And how much will I make? Well, I actually have invested in these stocks $79.89. You can see right here. My trade price on the shares in the unit was $79.89. So when you're looking at 1,000 shares, I've got $79,000 invested in this. So if I take the premium, $1,304, do this every 2 weeks, you're looking at 26 times even $1,000 every 2 weeks. That's $26,000. 26,000 out of 79 is about a 30% return on investment. Wouldn't you do that all day long? That is what I do all day long. Every 2 weeks, I'm resetting all my stocks. I'm just using this one as an example, and I'm going to bring up another one to show you how we actually set up an offer out there, or a ask. And when you're asking for something, that's the seller, that's the bank, that's me. I've got $80,000 worth of stocks here that I will offer to you to buy for $90,000 in 2 weeks. For you to get that privilege of buying it from me at 90, if it goes to 95, you're going to get it for 90. It goes to 100, you're going to get it for 90. To get that privilege, you're going to pay me $1,304. And from the day that we make the contract between the two of us, then there will be a buyout. And sometimes these buyouts are higher than the original premium, and you just got to wait. That's called the time value. The time value is 14 days, and you wait till it runs out and expires, goes down to 0, then you keep all the premium. If your price is too low and you start to bounce past or get close to bouncing past your price, then you have the option to buy yourself out. And it'll vary every day depending on what how many days are left, till expiration, depending on how close you are to the target price. There's a little bit of goodwill, intrinsic value built into it. Yesterday it was $25. Let's see what the intrinsic value is today. So on $225, based on 1,000 shares or 10 contracts, we're looking at 1,000 shares. We're looking at about it's much less. It's going to be about 20. Going to be 0.225. So you're looking at less than 25 cents a share to buy myself back out. So it's really gone down a lot since yesterday. I got the $1,304 2 weeks ago, went into my bank account, but immediately, it wasn't like I made the money immediately. I have to make it through the contract period, which is 14 days. Now, we only have 1 day left to go, so we're looking pretty good on this one. Looks like we might get to keep all of it, but knock on wood, 1 day can make a difference. So anyway, that's how you price, how you look at the stock, and that's how we priced it. So I promised that I would go in and show you, how close we are. 1 day now till the end, and we're currently at $85.94. We have a target price of $90. It expires on December 2nd at 3 o'clock. That's Friday at 3 o'clock. Now, the second part, let's look at the put. Remember, I put the $68 put out there. Well, it came down a couple dollars, but did it change the total? Not much. I have an insurance policy of 66 where I bought, I sold at 68, and I bought an insurance policy of 66 behind it, and it's still showing 2 on one, 2 on the other, so 0. They've pretty much gave up. They said, it's not going to get there. There's a probability of profit of less than 1% on the actual purchase, the insurance, and the actual sell of the premium was on 4 contracts, $452, so about $110 per. And then I bought the insurance for 4 on 336, which is about 80. So I'm making about $25, 20, whatever. But the difference between the two, 452 and 336, is $116. So I'm actually, at this point, could buy myself out of this contract for $2. I'm not going to. I'm just going to go ahead and let it go through today's market. Let it go to 3 o'clock. I keep the $2. The total is $116. I keep that also. So why am I pointing out the puts? Because the puts are what I'm using with the premiums that I make from the stock. I don't have enough money to go buy a $8,000 lot of 100 shares. I don't have enough money to do that. That's $8,000. So what do I do with the $1,300 that I just made? Well, I start doing some puts with it. Now, this is just a small amount. I only really invested. I earned a premium. You'd have to actually see how much I invested, which is how much they took out of my bank account to back this up, which normally it's about a 1-to-3 or 1-to-4 ratio. This one happened to be a 1-to-3. So I had to pay about 116 times 3. I had to pay about $450 to hold this. And then I made the $116 in 2 weeks on a $450 investment. What's the return on that? You're looking at almost 30% again. So the puts are backing up my calls. So my business is to run calls, either do another synthetic option on a call or go ahead and do a put. In this particular situation, I did the put. Now down here, these values dropped just a little bit yesterday because the price went from 87 and change down to 85 and change. It dropped $2. So the value did for the overall total, but I'm not worried about that because I got 568 days till expiration. This one I've got 778 days till expiration. This one I've got 778 days to expiration. When this product goes up, Alibaba stock goes up to probably over 100. I'm gonna be darn close to being above the trade price. Now, does that mean I've just lost money because it's only worth $3,500 or it's only worth $1,700, only worth $2,300? No. Remember, I'm making about $100 every 2 weeks. So, in a matter of $200 here difference, I can do that in about 1 month. I can do that in 4 weeks with a little bit of change. So we'll call it the full month. I can do it here too. I'm only down, about $600. How often? At $100 every 2 weeks. So I can do this in about 12 weeks. You don't see how much money is in the mark. This is actually just what the product is worth. This is called a synthetic option. And a synthetic option gives you all the full rights to sell covered calls on these. But if you end up selling your position, then this would close out. You have to buy another one. But if I look at my statement of accounts from Tastyworks, and I can do that at any time, once the covered call is done, like this one will be done on Friday, today, when it's done, that $1,300 will post to my Alibaba account, and now I have $1,300 in profit from that, $116 profit from that. I've got $1,400 going against these losses, and as you can see, $1,400 covers that one and that one. Shoot, it covers all three of them. So in one matter of 1-2 week covered call, I've actually covered the synthetic stock losses. Now this changes daily, it changes minute by the minute when your market is turned on, but I don't worry about it at this point. There may be a point sometime in the future where I decide to go ahead and sell them and sell this option, go ahead and take advantage of the $65. At this point, I could buy 100 shares of stock at $65 with this option. I would have to be above the 120 mark to want to be able to sell it, buy it for 120. But this one, $100, I can see that coming up pretty quick. But I've actually got the contract for 778 days. So at any time, I can go ahead and buy the stock for $100. Right now, I don't want to buy the stock for $100 because I could go out on the market and buy it for, are you guessing with me? Are you with me? $85.94. So this was the second video. This is December 2nd. The market has not opened yet, but I'm showing you the differences between the earlier part of the video, what it was worth on Thursday. I told you how much it had gone up on Wednesday and Tuesday, but this covered call was written when it was $75, and I went out and looked at it 90% out of the money, the algorithm that says, what's the chances that this is really going to hit $90? Well, I happened to pick 90%. Most of the time I pick 80. This time, if I had picked 80, it would have been an $88. 80% would have been an $88 target. I didn't feel too good about $88. I wanted to be at 90, so I took the 90% out of the money, and I collected $1,304. What would have happened if I would have picked $88, which was 80% out of the money? This would have went up to about $1,500. So the more risk, the more the reward. And that's really what the stock market is all about. But what covered calls is all about is you decided to own this stock. You decided to put $80,000 into this stock. And you want to make some money on it. Weekly, bi-weekly, put it out there for the month. You can do 3 weeks. You can put it 45 days. You can put a cover call out there for, up to 2 years. I do them every 2 weeks. And sometimes I do them every 4 weeks. If it pays, if the premium makes sense and I can put my target price out farther and still make $100 a week, that's what my target is. This one I made $130. $130 for the 2 week period. So I'm happy with that. And I didn't mean $100 per week for each one. I meant $50 per week and $100 for the 2 week period. So for the 2 week period, I made over my $100, $50 each week. And that would have been $1,000 if it had been just $100, but it ended up paying $130. So this is day 2. Now, I'll owe you another video tomorrow on Saturday after the market closes at 3:30 on Friday, which is December 2nd. I will make another video and attach it to this one and show you how we finished up. Hopefully it stayed at $1,304 because it didn't hit the 90. Now if it gets to, let's say, $87, goes from $85.94 to $87, then that means that my trade price, which is how much I paid for it, That's all the things there, but 71,000 for these 900 shares. This will go up to, $2 more per share, and this will go up to like 79,000, which is the mark, how much I can sell it for. On the options, it's how much can I get out of the obligation. It only cost me $2.25 today to get out of this. It cost me $2 to get out of this one. I can grab $2 if I want to take my insurance off. If you take your insurance off, it really does change the amount that you've got invested in that option, so I don't want to take it off. And then each one of these, this is how much it's worth. So these probably won't change much, but they go up to, an extra dollar, go to 87, then that might be 37, 3,800. This might be 1,800. This one might be 2,400. But we know that if we do the statement on how much money we made doing the covered call, we're not just going up a small amount, the $1. We're going up the $1,304. So this is Trading with Rich. I'm signing off. Please hit the like and subscribe button if you'd like to be notified. Hit the notification button and you'll see when I post a new video. I do videos on covered calls, puts, anything pertaining to finance we can talk about. That is not financial advice because you're not signed up as one of my clients, but I can give some discussions, say some what ifs. We just don't want to do any false advertising. We don't want to say something that's not true. A warranty is something that I guarantee is true. I don't want to put any warranties out there, but I will put a representation, which is this is a what if. What if we, make $1,300, every 2 weeks on an $80,000 investment? If we did that over the year, which is just an assumption, it's not a guarantee. What would your return on investment be? Well, it would be over 30%. So please hit the like and subscribe and give me some comments so that I know what you want to talk about, and I'll make those videos in the future. I want to be your friend. If we want to talk about other things, just email me at tradingwithrich@yahoo.com. Again, I will see you in the next video, which so far on my schedule will be tomorrow when I show you what this finalized out at. Thank you, and see you on the next video. Hi there, Rich Dickey from Trading with Rich. I'm going to do a short video this morning here. It is Thanksgiving morning, 11/24 on 2022. And what I thought I would do is just kind of talk a little bit about covered calls, cash secure puts, and then leaps, which are also called the poor man's covered call. Okay, so here's one of our portfolios, and I'm going to show you Alibaba. Now, Alibaba is, one of the plays that I'm making, considering the fact that I think that it has been drastically reduced in stock price over the last 2 years because of basically COVID and political rhetoric that's been going on. The company has a fantastic balance sheet. It has a fantastic cash flow. It's buying back its stocks at a high rate, $79. And as of yesterday, which was the day before Thanksgiving, it was $78.50. My average price on these stocks is right about $80. These 900 shares represent $71,000, 904 invested, and it's worth $70,650. So it's down about $1,200. So those are my shares, full shares. And then I've got, it says stock plus 7 options. So on some of the options, you can see down here, see this June 21st with 575 days left? Well, that is a vertical option, or some may call it a calendar option. I've got 575 days to make a move on this product. Right now, I paid $4,150 to be able to buy this for $65 on June 21st of 575. So we're looking at 2024. On the next one, I bought an option, paid $2,000 on it. You notice how the price went down a lot. That's because I agreed to pay higher for it, but I'm anticipating that it'll be above $120 in 785 days, which is a little over 2 years. So January of what would that be, 2025? I bought a $2,000 option. It's currently worth $1,400. On this one, $4,100. It's currently worth $2,900. Same date, January 17th of 2025. It has an option to be able to buy all these shares at $100. Currently, the market's $78.50. I paid $2,800 for it, and it's worth $19.10. Now, you might say, why, when you just bought these, and I think I bought these about 3 months ago, why are they down $1,200 and $600 and $980? Well, that's because you've got to pay some intrinsic value to actually have the ability to buy these shares at $65 or $120 or $100. Hopefully, your stock is worth more than the $80 that I've got invested. And I won't sell these stocks, these 900 shares up here. I won't sell these until they're way over. I'm hoping that it triples in value and goes up to about 210. I owned a lot of Alibaba when it was 225 and 275. Less than a year and a half ago, right about election time, it was $325. But it's $78.50, so it is what it is. So I'm going to show you how to read making on covered calls. And we'll kind of concentrate here on the 900 shares that I own 100% of. So what have I done? How am I trying to rent my stock out? That's what a covered call is. You own the stock and then you rent it out. You offer to someone on the other end the opportunity to buy the stock from you at a higher price. So what I did was, this first one, I put 2 contracts out there. The contract is 100 shares of stock. So this is 200 shares of stock. And I said, I'll offer it to you, the trader on the other end who's buying this option, and covered calls are an option for this person to buy this stock at $88 on November 25th. Now it's November 24th now. If it goes up to $87.99, I'll get to keep this stock, because most people are not going to go out there and buy it from me at $88 when they could get it cheaper at $87. They'll just go ahead and buy it off the market. So if they did, and I have had this happen once, maybe in the last 3.5 years, somebody actually did buy the stock from me at a higher amount that was in the market. Well, that's fine. Go ahead and buy it, and then I'll repurchase it at the lower amount. But I think that was a mistake that the trader made on the other end. So what have I done to make money here? Well, I offered to sell my stock at $88 on November 25th here, 2 contracts, and I offered $220. I could offer to get out of it, and it would only cost me $4. So I would end up making $220. Well, I'm just going to go ahead and let this go through tomorrow, and on two contracts at $4, I could buy myself out of it and relieve myself of the obligation of having to hold these stocks for the other trader. I could go ahead and pay the $2 and let that person, make my $2 times 2, and they collect $4 from me. But I'm not going to do that. I'm going to go ahead and just let it expire. And when it expires, then this contract goes away, and I keep all $224. Now, what you can't see here is that I did this particular one about 10 days out. So I made $224 in 10 days. Now on this December 2nd, I've got 10. Contract would be 10 times 100 is 1,000. And it's my POP. I got 7% chance of making profit on this. So that's a percentage of profit that they estimate you may make. And they're saying you're probably going to make there's a 97% chance, which is a very high chance that you're going to make all the money on this. So anyway, I put out 1,000 shares, said you could buy it from me for $90, but it'll cost you $1,304. And you need to know how to do this through your brokerage firm. And this is Tastyworks, which are fantastic people. I've been with Tastyworks, this particular brokerage, for about 4 years. And I love these people. They're really good, very low commissions, and they'll answer any questions you have when you call in. The help and customer service is fantastic. But their platform tells you how many days. I've got 8 days to go before this obligation expires. So what is the obligation? Well, it's a $90 call, and currently the prices are at $78.50. When I made this, it was actually $84.50. The price was $84.50. It's gone down a little bit since I made this, which was a 2-week call. So I wrote it out with 14 days. 6 days have already expired. The price went down a little bit. When the price goes down, it makes your ability to make the suggested or the contracted price of $1,300 makes it a lot more likely that that's going to happen. So they're estimating on these 10 contracts that I could get out of this obligation for about $265, which evenly divided number, that's only $26.50 per contract. And I could just get out of it tomorrow and make $1,039 and be done. But I don't want to give back that $265. I've only got 8 days to go. I got a little over a week where I could go ahead and replace that $265 into the $1,300. Now, when you look at how much I have invested in Alibaba, it's $79,290. It's currently worth $76,000. Why is it? Where's the difference here? The 1,200 on the 900 shares. Well, it's these 3 leaps that I have down here. All right. So basically, I did this one for 10 days. I did this one for 14 days. I made 20. I'm going to make 224 by tomorrow. I'm obligated to go ahead and sell my 1,000 shares. Let's say it goes to $92. I'm obligated to sell it to that person for $90. If it goes to $95, I'm obligated to sell it for $90. So there is a limit to the amount of profit you can make when you do a call, because you're actually saying, I'll rent out this house, but when it gets to be over $100,000, no matter how high it goes, 105 or 110, I'll let you have it for $100,000. And that is what a covered call is all about. As simple as that. And so that's 12 contracts. I have 900 shares that I own outright, and I have 300 shares that I have on leaps. And that's pretty normal. If you can do 3% every 2 weeks and do that, 26 times, you're looking at 3 times 20, 3% times 20, 26. That's pretty healthy. That's a very healthy return on your investment. But when you're looking at over 50% returns, that is helping. Like this $1,500 that I just am making on this particular one here over the next, over 2 weeks, that $1,500 is knocking out what I have down here for the extra premiums I paid to be able to buy these shares further into the future. So instead of doing 2 weeks out there like somebody else is doing here when they're buying it from me, I'm doing it, 2.25 years out. So I'm doing it 785 days out. I have said I will buy this for $120, but I will pay you $2,030 to be able to buy this, 100 shares at $120. Well, 100 shares at $120 is, $12,000. I only paid $2,000. I paid $2,000 because I feel like it is going to go over the 120. But I could lose that whole $2,000 if it doesn't get to 120 by January 17th of 2025. I could lose that all. So in the meantime, I use that to go ahead and do a cover call. So these 3,
are part of the 9 up here, and I'm averaging 1,500 a week, so it doesn't take very long. Now, I'm going to have those leaps for over 2 years, 785 days, and unless I have to sell those shares, at the current going price, I can easily cover what I've invested in those leaps. On the 900 shares, if this thing were to go to $90, fantastic. I'll let them go. If they go to $90, I'll let 1,000 shares go. And what does that mean? Well, 90 times 1,000. How much is that going to go up? It's going to go up $9,000. So instead of being worth $70,000, it'll be worth right about $80,000, and I have $71,000 invested. And I haven't let one go in this whole year. In 2022, I have not had any of my shares go over the price. Now, part of that's because the stock market's been crazy, and it seems like everything just keeps going down. You just have to be able to, ride out the storm, wait for your shares to come back up. The other part of the covered call is that when your stocks do get to be, say, 25% of their original value, you don't want to be trying to sell those back to somebody at a price that's way underwater. So that's a whole nother topic and a whole nother video. So this is a cash secured put. And on December 2nd, 8 days from now, I've got 4 contracts out there where I've agreed to $68. Now, if it drops below $66, I put insurance on that. So that's the limit I'm going to go. I'm going to actually own these shares at 66 and pay 68, so about $200. So basically, when I bought it, I sold the opportunity to buy those shares at 68 for $452, and then I paid insurance at 66 on the put, and so overall I can make $120 on this. I'm doing that every 2 weeks. I'm picking out a price that I think I could live with. Do I think it's going to go down to 66? The probability of that, as what this is saying, is nope, probably not. 97% chance that that's not going to go down to 78. That's a cash secured put. So you've got stocks you own, a covered call at $88, going to make $224 on that. A covered call at $90, I'm going to make $1,300 on that. A cash secured put that I put up about triple the amount of money that I put into this. So I put in, I'm going to make $120 or $126. I'm going to make $126 on this, but I had to put some cash up. It wasn't free. You couldn't just go out there and do it. I put up about 1/3, so I had to triple that. So the 126 times 3, I put up about 388. I could get out of it for 304. I could end up just saying, I'm done, let's close it tomorrow and make my $84, or I could go ahead and keep it till next Friday and try to make the whole amount, which is the 126, which is what I'm going to do, because I don't feel like it's going to go to 68. I know that was a lot to cover, but this is a good example on how to do covered calls on your 900 shares of stock, covered calls on your 300 shares of leaps, which are now called poor man's covered call, putting covered calls on an option. It's also called a synthetic option. And then I did a cash secured put. So what am I making in 2 weeks? The 1,500 plus the 126. And what do I have invested? $76,000. So if I made, let's just call it, instead of 1,600, let's just call it 1,500 every 2 weeks, which is very easy to do. That would be $3,000 a month, and there's 13 periods when you take 4 weeks into 52. So take 13 times 3. You're making $39,000 a year on covered calls on an investment of 76. Not too bad, not too shabby. And where's all the risk? Well, the risk is you own the stock. Well, if you're going to own the stock anyway, you might as well rent it out and let other people play options on your stock and be the bank. Be the one that actually owns the stock and rents it out. And trust me, it's not hard to rent it out at these prices. A couple times, and then you agree to a price and you're done. Now you have that obligation until the date that you set for your price. And for me, it's 88 by tomorrow, and it's 90 by next Friday. So that's how you do covered calls, cash secure puts, and long expiration anticipated products, and use those for a covered call. So 900 and 300 are 1200. I got 2 there and I got 10 there. So I hope this was informative, an actual live account, and where it sits today, November 24th, Thanksgiving of 2022. This is Rich Dickey from Trading with Rich. You're on my YouTube channel, and I'm trying to share products with you so that you can actually learn how to do these. Thank you, and I'll see you on the next video.